Okay, good afternoon. So I'm Doug Pryor, an actuary with Rowland Letson. I'm here with Katrina Pryor. And we're gonna kind of run through some CalPERS issues. And then Katrina's gonna cover GASB 68 and OPEB. So let me go ahead and jump in here. Okay, so we want to kind of cover what's happened recently. So a big thing is of course investment returns, and we're sitting here early July. There's about to be a big announcement next week on what the 2026 return was. Which we listed there are 24, 25 were good years, 9.3 and 11.6. 26, what we do know today is that the portfolio went up a little over 10%. So that's just the year over year increase. If you consider the cash flow on the portfolio, we'd estimate probably they're north of 11%. So again, this could be another good year. Kind of interesting thing is that I was tracking it daily, June 29th to June 30th, the portfolio dropped about 2%. So that's unfortunate, but nonetheless, probably looking at north of 11% return. That will be announced next week. So we're going to talk more about investment returns and the impact on contributions a little later. But then the second section, I want to cover kind of some events that have occurred. So that first bullet, last year CalPERS did their asset allocation study. And they made some big changes to how they're investing your money. And we're going to talk about that a few slides later. That is effective, really was effective beginning of this month in terms of reallocating the assets. One of the things also has occurred is that if you're familiar with the risk mitigation policy, that was set almost 10 years ago, the idea being that they wanted to be less aggressively invested. They wanted to reduce the volatility in the portfolio. And they had this risk mitigation policy to move them in that direction. They have essentially abandoned that at this point. Last year, they removed what they call the automatic trigger to have that implemented. And on top of that, after having another good year of investment return, they did not implement the risk mitigation policy once again. And you see a few slides later, again, the reason for the risk mitigation policy is sort of the intent was to reduce volatility. What you can see in a few slides later is that they've done the opposite over the last 8 years or so in terms of volatility on your investments. The other thing, in addition to the asset allocation study that they had new demographic assumptions that they did the new study. This is the first study that included COVID periods. So there were spikes in mortality rates, due to COVID during that period. I think CalPERS looked at that as I think we all hopefully looked at it as a one-off kind of a thing, and did not include the impact of that to be carrying forward. So overall, in terms of demographic assumptions, it's going to vary by plan, vary by a lot by retirement formula, but there weren't big changes in terms of the assumptions. And CalPERS had for the funded ratio. Oh, that's a lot louder now. Thank you. Okay. The funded ratio under the new assumptions versus the old dropped by 0.3% ratio of assets to liabilities. So the new assumptions are not going to have a big driver. There will, as I said, be big differences between individual plans, but overall, it's not having a big difference. So that's kind of a number of recent important changes. I do want to talk a little more about the investment returns here. Go to the next slide. This has historical returns through June 30th, 2025. These historical returns, let me just explain the graphic just to so you know what's here. The blue is showing the return that was reported by CalPERS. And then the green is the investment gain or loss. So if you look at, for example, the last data point to the right, what you have there is the reported 11.6% return that exceeded the assumed return by a little over 5%. So they got 11.6. There was some sort of a 5% gain on the assets. The CalPERS is going to pull into your contribution over time. And one of the things that we're going to come back to later too is look at the average return box. If you look over the years, you know, the current assumption is 6.8% long-term return. There's not really a period though that's below 6.8, right? There's a 20-year 6.7. That will probably go north of 6.8 once we get the 26 return. The other thing is the 5 and 10-year, you can see are between 7.2 and 8%. And this is because of the way CalPERS pulls those investment gains, which are basically the green bars there, into your contributions. It means that there's sort of a deferred recognition of those overall gains at 8% for the last 5 years. Doesn't immediately hit your contributions. They're going to phase it in over time. There's some numbers later on kind of showing you how that sort of works through your contributions. And you see what ultimately is going to happen is most agencies are not expected to see the increases that we've been seeing. I've been looking at CalPERS rates for over 20 years, and it seems like this is maybe the first time you know, over the last couple of years where we're looking at agencies and saying, no, you're not seeing this big increase coming down the road. Things are leveling out and dropping off. Over the last 20 years, almost every agency, every time we looked at this, you kept seeing increases. We're not generally at that point anymore, which is certainly good news. Certainly going to vary by agency. And the other caveat here, of course, is that it's the way things look today. You look at these returns, last couple of years, 9.3, 11.6. We're looking probably north of 11 for June 30, 26. We're coming off 3 good years. All it would take is a market correction or downturn here, right? And things will change quickly, of course. But that's kind of where we are today, is there might finally be some relief here. So let's move forward to the investment policy, which I wanted to cover. Okay. So as I said, they made a pretty significant change last year that's effective now in beginning of this month. And it really, honestly, I'd never sort of seen this investment approach before. And what you have there is, if you look at the columns with numbers in there, that's historically what they've been doing with, you have these asset classifications on the far right. So for example, equity, private equity, that first column on July 1, 18, they had an 8% target private equity mix. They did this study 4 years later, they bumped that up to 13%. Actually did an intermediate adjustment, hit 17%. And now today, you see that column is blank. And the reason is because they've really kind of revamped how they look at this. They no longer have target allocations for these individual asset classifications. What they have is they're looking at the total portfolio. They call it the total portfolio approach of TPA. Their benchmark is going to be a 75% equity, 25% fixed income portfolio. And sort of that's their benchmark, and they're going to take a risk around that. And they have limits on how much risk around that they'll be able to take. I personally, I'm still trying to get used to this, and just you know, if you listen to what the staff told CalPERS board, they said you're going to have all the information you had before, plus more. I think that's true. And so they said that the clarity here is going to be much greater, and the visibility is going to be much greater in terms of what's going on. I think that's right. But especially for the CalPERS board and for the investment consultants working on this, I think for a common person like myself, it seems much more like a black box, right? I used to be able to say, okay, well, look, they were at 17% private equity, and maybe they had a range of plus or minus 2-3% or something around that. Now, there's no longer that restriction. Now, because of the overall risk that they're going to be limited in taking, it's not as though they can put 90% in private equity, right? They're going to be they can't do that. They do have these other portfolio overall limitations, but it's to me a much bigger kind of a black box. And the other thing I want to point out here is that last row, because I referred to this earlier, but now this is covering, really 3 asset liability studies that CalPERS has done going back to 2017. Look at that last row, the standard deviation of the portfolio, you see that steadily increasing, right? So that means more volatility in the portfolio. Now, I think it is important to distinguish between standard deviation and risk, right? Standard deviation is measuring the year-to-year volatility of the investment returns, right? In terms of long-term risk to the funded status and the ability of the fund to pay benefits, it's a little more complicated that. So standard deviation is kind of one measurement of risk, but it's not the only measurement of risk. Nonetheless, what you see there is that they are taking on more volatility, certainly, to get to their returns. And I don't want to mention this, but I don't know if I mentioned this, but they have not changed their discount rate assumption. So between the second last column and the last column, they kept the 6.8% long-term return.
Doug, we have a question.
Oh.
Just curious how CalPERS performance compares to the S&P 500 index. Can you reiterate the question?
Yeah, the question is, how does CalPERS performance compare to the S&P 500 index? Off the top of my head, I do not know the answer to that. I would expect, my 2 cents would be off the top of my head. Markets, the S&P's performed, the stock market's performed exceptionally well over the last several years. So what I would expect that CalPERS being diversified probably has not achieved the same returns as S&P 500, but I don't have numbers off the top of my head to support that. But, so we're going to come back to the impact of investment returns on contributions a little later, but I did want to talk about a couple of proposed legislation that is out there you may have heard of. The first is AB 1383, and this, I think the California League of Cities is involved in working and looking at costs. CalPERS has issued some calculations on what the cost of this legislation would be. But let me cover kind of what it is. So first of all, it's really kind of a change to PEPRA, and it's a change prospectively is important to note. So that means that benefits, let's suppose this becomes, I think maybe it has a target effective date of January 27. And as I said, it's proposed legislation. This has not been passed yet. But if it has a target effective date of January 1, 27, what will happen is benefits accrued at that point for PEPRA employees will be fixed at that point. And what will happen is accruals in the future will be changed under the provisions here. Okay, so it's going to be a prospective change to PEPRA. And there are really kind of 2 major changes. And I should mention, which might tell you a lot about what this, what's happening with this bill, is it's co-sponsored by PORAC and the California Professional Firefighters, right? So what you see is the first change is a change to the PEPRA compensation limit. So right now, the compensation limits are about $160,000 to $190,000 per year. So that's the most pay that can be used in determining the CalPERS benefit. This legislation would increase that to $290,000. Both of these amounts are indexed with inflation in the future, so they would both change going forward. But they would change this, and this provision for pay would be for miscellaneous and safety. Okay, but there would be important changes to the safety formula. So not for miscellaneous, but for PEPRA safety. Basically, the PEPRA formulas that are prescribing a certain percentage of pay at age 55 at age 57 would move to age 55. So it would basically be a benefit increase for safety members And for example, the most common, that last row, 2.7 at 55 would be increased to 2.7 to 57 would be increased to 2.7 at 55. Okay. So that would be a pretty significant increase, kind of a few points of note with respect to this. You know, CalPERS has said that I think I forget the exact dates within the last year that PEPRA has saved state and public agencies $5.8 billion since it was enacted. Just for reference, if you recall, PEPRA was enacted, it became effective January 1, 2013, $5.8 billion in savings. They've done an analysis on this bill and said that the present value of the benefit increases here for current employees is what was the number? Over $5 billion. So this would be a big deal, right? It would mostly impact safety, of course, but it would have a big impact on your pension costs. The other thing is, I didn't mention it, but safety right now under PEPRA, you're limited to the formulas, the 2 at 57, 2.5, or 2.7 at 57. They would give you agencies the ability to move for PEPRA employees to 3 at 55. So that's optional. The other formulas would be sort of an automatic transition. Okay. So that's one piece of legislation out there. I'm not an expert on the whole process of how stuff gets approved through, but it's, you know, works through our legislator, but you can see the notes there, what I defined on the current status. So, you know, and then in terms of how likely it is to pass and what's going on, I really can't address that. So the other bill I wanted to mention is these are both, of course, related to CalPERS. This is AB 1319.
Quickly, a question on the prior slide. If change is approved, would it only affect CalPERS, or could it also be applied to other pension plans like county plans?
As far as I know, we would apply to county plans too.
Okay.
Yeah. Good. Yes. Although there was separate legislation, I mean, there were sort of separate provisions for CalPERS and non-CalPERS with respect to PEPRA. This is my understanding changes all of PEPRA. And so I think it would also apply to the 37 Act systems too, but I, off the top of my head, don't, you know, that could, I'm not certain of that. Okay. Okay, so the other piece of legislation kind of gets back to investments. And in this case, again, this is not passed, it's kind of something that's out there. And it would expand disclosures for pension fund alternative investments. CalPERS has a significant number of those. And so it would really require a lot of different disclosures with respect to those alternative investments, the privately held equity, privately held debt. And so what has happened is CalPERS looked at the bill, and what they said was, look, you know, this is going to really bog them down, create a competitive disadvantage with respect to these investments. And they're going to have a significant, the ultimate impact will be a significant reduction in their rate of return. Okay, on the privately held investments. And overall, that would be a 50 basis point reduction. But they're saying if this bill passes, their 6.8 would go down to 6.3, right? Which would be, you know, a pretty tough bill to swallow. They have said that would kind of, you know, reduce funded ratios by about 5%. We can get the funded ratios in a little bit here, and increase safety. I think the numbers they had for miscellaneous, about 2% of payroll going up for the normal class, safety 4 to 5%. So it would have a big impact, which it's a, you know, it's a bill. It seems, I don't know a lot of the background here, it would seem, you know, the kind of thing where it seemed like a good idea on the face of it. And, you know, you think, well, what's the harm? There should be some more disclosure with respect to this stuff. And ultimately, there's kind of a big impact here if it were to pass. So let's get to legislative bills that are out there. Said neither of those have have passed, and honestly not sure, how, I know they're being discussed. I'm not sure how likely it is that they'll pass, but let's go on to the funded ratios here. So these are June 30, 24. This is the latest data that we have from CalPERS at this point. So what the graphic is showing, so we've broken this up by miscellaneous on the left side, safety on the right, and then within each group we have the pooled, standalone, and then all plans. And then the graphic above is the green is the median funded ratio. The dark blue captures 50% of the plans, and then the light blue 90% of the plans. So you can see kind of where things are on average, and kind of the range here. So as you might expect, this safety plans are a little lower funded ratios than the miscellaneous plan. Funded ratio is the ratio of assets to accrued liability. Thing that I kind of stumbled on in looking at this was the standalone plans being lower funded than the other plans, and the only reason I could come up with for that was that certainly the pooled plans tend to have more of the special districts, which might tend to be better funded. I think that is the case. So that was the only reason I could come up with for, it might be something else I'm not thinking of, but why the standalone plans seem to be not as well funded as the risk pool plans. Some other thoughts, but that's kind of the main reason why I would think that the standalone would be a little lower funded. Again, this is June 30, 24. So based on kind of some publications from CalPERS, I think what we're seeing them say is that with the good investment returns, the funded ratios are expected to kind of go up 5% each year from June 30, 24 to 25, and probably then to 26 too. Although again, we don't know what that return is, but if it's somewhere around 11%, you might expect the 77% funded ratio June 30, 24 might be closer to 82 by June 30, 25, and by June 30, 26 could be as high as 85 to 90% in those range on average, right? These are median funded ratios, but gives you kind of an idea where everyone sits. The funded ratio, it's good information. It doesn't get to the magnitude of sort of the pain or the magnitude of the cost for agencies. So we also included this graphic, which is in June 30, 24, but it's looking at what is the unfunded liability as a percentage of payroll for public agency plans. Again, miscellaneous and safety broken down here. And I should have mentioned on the previous slide that was on this one, just keep in mind we didn't start the scale at 0%. So what looks like probably a wide range is not as wide as it visually appears to be, right? It's not as big a spread as you might think there was if you just glanced at this. Let me go back. Funded ratio, I'm sorry, unfunded liability is a percentage of payroll here. I think there's no surprise. You have safety and unfunded liabilities as a percentage of payroll much higher than for miscellaneous. And then you do have that same sort of characteristic with respect to the pooled and standalone plans here, just with an opposite in an opposite direction because of the relationship between the funded ratio and the unfunded liability. Let's go forward. There's one other kind of background slide that I just thought was interesting I want to cover, and then we'll get into the kind of contribution projections and why we're seeing contributions kind of leveling out across the state. So this is out of CalPERS 2024. They do an annual review of funding levels and risks. So this is a chart pasted right out of that report. I'm not sure why they didn't publish 2025. They've been doing this annually. And aside from the fact that they're going through experience studies last year and maybe didn't have time, I think try to find out. I know it hasn't been published, but why it hasn't been published, I don't know. So this is 2024. And what the graphic here is providing is in millions of dollars, additional discretionary payments or ADPs. And you can see the source there, the stripe blue are pension obligation bonds, right? So you hear the spike there, almost I guess that would be $6 billion between 2020, 2022. That's kind of, fallen off a cliff as interest rates increased in 23 and 24. In fact, I don't know if it just rounded to zero, but maybe there actually were no POBs in those years. You see additional discretionary payments statewide at about the $400 million range roughly. Okay. Certainly agencies have been pumping in significant amount of additional money to CalPERS. I think part of the reason, obviously, for this is, as I said earlier, it's like I've been doing this for 20 years. Every time we look at an agency's contributions, we always look and say, you got increases coming down the road, right? And you're gonna have to you need to find a way to deal with this. And this is what a lot of agencies have done. I think the landscape is kind of changing now, as we'll get into here in the next few slides. Man, time.
It's okay.
So, I realized that first of all, this is what we're going to talk about here is all based on expectations, right? Where we are today and what we have. As I said earlier, this could all change on very quickly with a poor return this year. So why are we seeing kind of leveling out of contribution? So when I look at the primary drivers here, I didn't list probably what might be the most important is funded status improving, right? I think as I'm more thinking of the slope and not the magnitude, I didn't put that one down here, but certainly that has a reason for why contributions are not increasing, expected increase in the future. Primary drivers, so you go way back to June 30, 2019, they changed the amortization schedule for new basis, basically new liability increases or decreases for the investment returns were changed from being a level percent of pay to being a level dollar. So what that meant was that to the extent you have investment losses, you were not scheduled to pay that off with higher payments in the future. It was sort of leveled out. So that's helped level out your contributions and avoid increases in the future. The second bullet, on the future investment returns, is a little bit of a esoteric issue and something that's not really included in CalPERS's analysis, but I think it's an important change that's occurred. I talked about doing this for a long time. Every time we look at the investment advisors' forecast, and this included those at CalPERS, they would always, over the last 20 years, they always say, well, for the next 10 years, we expect the returns to be X. But after 10 years, they're going to be 100 basis points higher. They get more back to normal. And I remember for a long time, we would sit there and say, well, if every time they look at this, they keep saying, well, the next 10 years will be low, but then things will get better. And they keep saying that for 20 years, you'd have to say, wait a minute, something's not right here, right? Well, they have changed this now. So now if you look at what investment advisors are saying about the next 10 years versus the following 10 years, they're very close together, okay? And the reason this is an issue with respect to where your CalPERS contributions are going to go is because CalPERS only uses one investment return for their valuations, right? So what happens is if CalPERS really expected 6% for 10 years, followed by 8% after that. That averages to 7. Well, they don't use 6 and then 8, they just use the 7. And so they use the 7, and for 10 years, you're going to get 6, and that's going to be investment losses, meaning your contribution would go up. That issue is kind of gone because the spread between expected returns in the first 10 years, followed by the thereafter, has really been squeezed down. We're in investment advisors, so I'm not an investment advisor, but that's what they're saying. And so that's helped. If you really drill down on this in terms of where you think contributions would go, that has resulted in leveling out of contributions. The final and really important issue here with respect to contributions in the future is this last section. And if you recall, when we're looking at historical investment returns, because the last 5 or 10 years, they exceeded expectations, right? And as I said, when CalPERS has when they have experience exceeding expectations on investment returns, they don't immediately have that reflected in your contribution. They have a ramp up, and so you're coming through a period of 5+ years where returns have exceeded expectations. It's going to take a while for CalPERS to let you take the credit for all those good years of investment returns. So we have a few slides here to kind of show you how this is expected to pan out. So first of all, let's look at a simple example just to understand how CalPERS is amortizing the investment gains. So or losses, but this is a sample for, suppose you have $1 million loss. How does CalPERS have you pay that off? It's basically these blue bars here. So you can see the first year on $1 million loss, you pay about $20,000 in your contribution. That ramps up over the first 5 years. At the end of the 5 years, you end up paying whatever that might be, around $110,000 for the next 15. It's all paid off. Year 21, there's no more payments left, right? And this works. You have the mirror image for investment gain, right? This is looking at if you have a loss, here's the payments. If you have a gain, these are all going to be credits coming down the road. So the initial payment you see here in year one, $20,000 out of $1 million is that 2%, right? So you're paying 2% of the balance. So and that rounds up over time. But so if you look at how CalPERS is having you pay off, in this case, investment gain, the balances go up over time, right? So you start with that $1 million loss, but they don't have you pay even interest on that. So what you see is the balance starts going up before it starts to come down. You don't pay off the, you don't have the initial balance being lower than, you don't have the balance on what you owe being lower than what initially was for 7 years roughly, right? So this is just the structure of the payments, and the whole idea here is to stabilize contributions, right? That's the idea here, and it works well. And I think now we're kind of at a point where we've had enough in investment gains that it's sort of built up, and now you have a lot of these that are sort of deferred to be have deferred recognition and can be coming in down the road on your contributions. So this last chart is what we're trying to do here is say, okay, what if you had just $10 million in assets June 30, 25? Okay, so with the $10 million in assets, that would project out to be, you had X dollars years ago, but what this is showing is for that magnitude of assets, what are the amortization credits on the investment gains that you're expected to have? Okay, so the red line is showing kind of where we are today, right? With to the right of the red line being before fiscal year 26, and then to the left of the red line being before fiscal year 26, and to the right of the red line being after today, essentially, right? And so what you see here, a number of things. First of all, what you see is to the right, look at how much those credits are ramping up from a 20,000 plus, maybe it's $25,000 credit for last year to probably about $150,000 credit a number of years down the road, whatever year that might be. That might be fiscal year 33. So again, this is for $10 million in assets, right? So this is, it used to be 10 years ago, like I said, we always go out and project contributions and they're going up, right? And you have kind of the opposite effect of this. You have investment losses. this, you got the mirror image here, and that the investment losses were being phased in and coming up. They were amortizing stuff as 11% payroll, all of that escalated contributions. Now we have this situation, right, where you have contributions. This is not only limiting contributions, but is going to expect to kind of have the contributions decline over time. So what you see here also now, of course, there can be a million things that change before, say, pick a year, 2040 here, right? But based on what we have today, there would be some kind of bumpiness. Here we have 2044, that drop there in the credit is because that's when the 21% return drops off. So that huge credit drops off. The following year, you have the -6%, which was a large charge. So then that comes off, and so you jump back up. So, long term, if nothing changed, there would be huge volatility in business. So there'd be a lot of things change between today and the whatever we're showing here, like close to a 20-year projection. Okay, but the bottom line is I wanted to kind of emphasize, and again, I don't think I mentioned this. To illustrate this, we also did take into account some good return for 2026. We assumed 11%. Right? I think early on I said, look, the portfolio is up about 10. You take into account cash flow, it's got to be north of 11. Final number will be out next week, or a number will be out next week. But we did take that into account too. Ultimately, what you're seeing here is some good news down the road in terms of the direction of your contributions. Due to historical investment gains. So that's the information I have on CalPERS. Now I'll turn it over to Katrina to talk about GASB 68 and OPEB issues. Thank you.
Good afternoon. My name is Katrina Pryor, and I'm consultant actuary at Travel Lesson. I do want to jump to discussion of GASB 68 and what you can expect with your upcoming 2026 GASB 68 disclosures. For the sake of time, we are running a little behind. I'll skip basic definitions and start talking about what you can expect. So for GASB 68 reporting, keep in mind there is 1 year lag. So numbers you are to report in your financial statements in 26 are actually measured as of June 30, 25. So to understand what we can expect, we should really think about 24-25 fiscal year. As Doug mentioned earlier, that year CalPERS had a very good investment return, and they overperformed on their assets by roughly 5%, which is great. So what that means for us, assets went up, there is significant investment gain. Okay, so we would expect that pension liability going down. However, there were other factors going on. Experience. Actually, for the last 3 years, CalPERS experience have been worse than expected, and the magnitude, at least for the cost share risk pool that I looked at, was very similar from year to year. So there is an experience loss. However, the magnitude investment gain was more than 3 times over the experience loss. So it was more than enough to offset that headwind. And there were no assumption changes. So overall, and we expect that in your 26 GASB financial statements, you will be reporting lower net pension liability, which is great comparing to your 25 disclosures. Do keep in mind there's a lot moving parts going on. So for your particular agencies, if there are some big changes that are not covered here, you might see difference. But for the most of you, and already prepared just about half a dozen of GASB 68 disclosures for agencies we work with, I've seen consistently the reduction in net pension liability. And also, we have a benefit of talking about this now in July. Well, Doug mentioned we don't have even a preliminary CalPERS return just yet. It's going to be published probably sometime next week. We know it's going to be most likely another very good investment year. So what does it mean? We can actually look at 2027 disclosures and think about what are we going to be reporting then. Again, pretty big investment gain, let's assume we don't know experience yet. Let's assume it's similar to the last 3 years. Also, magnitude pretty much similar because it's been pretty stable, at least for risk pool. There is one more thing that is coming with the next disclosures. It's assumption changes. And I've talked about it a little bit. It's not quite clear how it's going to pin down for each individual agency because it really depends on your group. But overall, assumption changes will likely increase your liabilities a little bit, but it's not going to be, most likely will not going to be enough to offset the big investment gain. So the good news is 26 reporting coming up, you're going to be reporting most likely lower net pension liability. And hopefully, it seems like even for 27 reporting, you're going to be reporting yet lowering of net pension liability again. So that's a great news. After that, I want to switch topic to something different, to OPEB. OPEB is other than pension employment after employment benefits, post-employment benefits. And examples of OPEB would be agencies paying for health, dental, medical, vision premiums, also life insurance. And there are different entities that an agency can partner with to provide healthcare benefits, OPEB benefits to their retirees and employees, but by far, CalPERS is the biggest. In fact, covering 1.5 million lives, CalPERS is not only the biggest in California purchaser of public health benefits, it's actually second in the country, only second to federal government in terms of purchasing public health benefits. That's why I want to focus a little bit on CalPERS and recent updates to their public health plan. CalPERS Board of Administration is a governing body that makes decisions for the CalPERS health plan. And they actually had a meeting just last month where they made a number of interesting recommendations, and they also published their preliminary 2027 premiums. So that's what I want to focus on. Do keep in mind there's going to be another meeting of the board next week, in less than a week, where we're going to publish their final premiums for 27, and we'll make decisions on recommendations. But from our experience, it's very unlikely anything will change from what was discussed on the meeting last month. So let's dive in. First big change is United Healthcare Basic Plan is removed. It's no longer being available. And CalPERS' explanation of that was that United Healthcare basic premium increases were much higher than expected by CalPERS, and when CalPERS asked them to provide background why their increase is so high, they basically did not provide anything sufficient to justify the increase. So United Healthcare basic plan is gone. And I understand that CalPERS will be practically reaching out and having webinars and educating how to transition people, your employees and retirees from United Healthcare, but basic plan is gone. They do add one more plan, Sutter Health plan, to their portfolio. And another change on United Healthcare this time is Medicare plan. They're actually making small administrative change. Not much going to change for the participants, but separating medical and pharmacy benefits will allow them to capture more federal reimbursements, which will in turn help to stabilize premiums somewhat. It's not new practice for CalPERS. They did very similar thing for Blue Shield, so it's nothing new. It's just to help with their federal reimbursements. On PPO, there are also two changes on PPO. Surcharge for PPO plans will be reduced by 50% in 2027. And again, the goal here is to make premiums less stable if possible, and also it's a reflection that PPO plan funded status is significantly improved from where it was before, so CalPERS feels comfortable removing those surcharges. And actually, they're talking about removing the charge completely in 2028. And another update to PPO plans is that
Fertility benefits will be added as of July 1, 2027. So that's their recommendations. What about premiums? Here I have a history of last 2 year premium increases and preliminary 26 to 27 premium increases. It's not actual premiums, it's just percentage increases. So if you look at basic, I can use it. If you look at the basic premium increases, overall total weighted average change is roughly 6% at the bottom here. So not too bad, but if you look closer, there are some plans that went up by 11%, like Anthem plans, and some plans like Kaiser's that went up only by 2%. However, not such a huge drastic difference. If you look at Medicare premiums, overall is only 1%, but look at that. There are some plans like Blue Shield plans went up 15%, and Kaiser actually went down 6 to 8% depending on the plan, Medicare premium. So I don't think 1% really reflects well what happened with Medicare premiums because it's all over the board. We have big increases and we have decrease for Kaiser. I do want to point out the reason why I'm showing you history for the prior 2 years is because, well, this year doesn't look terrible, meaning this year. 27 premium increases don't look too bad. Look at the prior years, especially 24 to 25, you had 9% increase overall on basic premiums and 23% on Medicare. I know I'm as an actuary is the one who is worried about Medicare premiums because think about it. If your agency has an OPEB plan and if you're paying your retirees for the lifetime, you're going to be paying those Medicare premiums for a long, long time. That's why as an actuary, I worry about that. Obviously, you're also looking at basic premiums that are much higher in dollar values, while they don't go as much as Medicare premiums went up in recent years. It's a huge burden for your agencies. You're paying active premiums, you're paying your 365 retirees, and those dollar amounts are big, and they keep increasing. And then we have 25 to 26. Premiums went up again, not as drastically, granted, but still 8% for basic premiums and 11% for Medicare on top of 23 in the prior year. So it just puts it in perspective. While this upcoming 27 premiums did not go up as much, you still see a huge increase over the last 3 years. If you look at, I think I even wrote down here, Medicare premiums, again, as an actuary, I'm hyper-focused Medicare premiums. United Healthcare, over 3 years, went up by 56%. Blue Shield premiums, Medicare went up by 51% in just 3 years. So it's a huge increase. Well, 27 seems like a good year. We need to keep in mind that it's after a very bad 2 years. And again, a few things to note here. It really depends where your population is in. You might be a lucky one where most of your people are in Kaiser and you're not going to get hit by such big increases. But you might be a lucky one where your population is more and more expensive plans that are increasing like crazy. So it truly depends on your particular population and where they're participating. And the other thing to keep in mind, whoever's doing, you're actually who's preparing your population, they already have a certain trend built in. It's not like there will be no increase in premium. So your gains and losses will be flowing through discrepancy between actual increases and wherever your actuary assumed. So it's not like you're gonna see 11% or 6% increase in the liabilities. It's a difference. A little more information, we just thought it's interesting. This is 27 premiums for basic plans for Region 1. Comparison of 26 current premiums and 27 in red for the next year proposed. Sutter Health is a new plan in CALPERS, and actually it's one of the cheapest ones. If you look, the only plan that is cheaper than Sutter Health is Western Health. Everything else is more expensive. And we also have a similar chart for Medicare premiums and their increases, non-increases on first premiums, decrease on Kaiser. For the sake of time, I'll skip and won't talk much about that. And the last thing I wanted to cover is CRBT returns. As we're talking about all of the developments that will be pertain to your upcoming disclosures, a lot of our clients partner with CRBT for their OPEB trust. So we wanted to summarize what we know so far. Please keep in mind that we still don't have the final CRBT return numbers for their fiscal year, but the latest numbers we have is as of end of May 31. And look at those returns. For strategy 1, it's almost 18%. For strategy 2, 14%, and almost 12% for strategy 3. And just for historical, we put here CRBT strategy 1 historical chart. CRBT 1 is by far the most popular among our clients and in general with agencies in PEMCA. So here's the history for you. It does not have 26 because we still don't have that number, but similar to what that was showing to you on CALPERS returns, we have pretty good year, a couple of pretty good years in terms of return. This higher than expected returns, almost double of what was expected. So overall, it's a great news. We do need to keep in mind there are a lot of other moving parts. Investment gains do help a lot, and then reflected in your SB68, in your upcoming contributions, on your OPEB, but there are a lot of other things going on. At this, I want to finish our presentation. I want to thank all of you for your time today and to Bradley & Associates for inviting us forward today. And we would like to open for any questions you might have. Do you have any questions? Okay. Good. They do on time. Okay, looks like we don't have any questions. Thank you so much.